Let's be honest, for a lot of people studying for the SAFE exam, the math section can feel, well, pretty intimidating. But I'm going to let you in on a little secret. You don't have to be a math genius to ace it. Not at all. It's really just about knowing the formulas, knowing the rules, and knowing the common tricks they'll throw at you. And that's exactly what we're going to do in this explainer. We're going to break it all down step by step so you can walk into that test feeling totally confident. So here's our game plan. We're kicking things off with the absolute foundation, how to calculate income. From there, we'll dive into the core qualifying ratios that lenders use to figure out risk. Then, we're tackling the big one, that monthly payment formula. We'll wrap things up with some really critical compliance tests for high-cost loans, and then finish it all off with a cheat sheet of the most important stuff to remember for test day. All right, let's jump right in. First things first. Before you can even think about a loan amount or a ratio or pretty much anything else, you have to know exactly how much money the borrower is working with. And when it comes to the SAFE exam, you gotta do it their way. Now, this slide looks simple, right? But this is probably the #1 rule you absolutely cannot forget. The exam will only, and I mean only, ever use gross income. Not their net pay, not their take-home pay. It is all about what they earn before anybody takes a slice of the pie. So if you see a question with a pay stub that's loaded with deductions for taxes or insurance, your job is to completely ignore them and find that top-line number. Okay, so how do we actually get to that magic gross monthly number? This table right here is your secret weapon. The goal is always, always, always to convert whatever pay frequency they give you into one consistent monthly amount. Now, pay super close attention to those multipliers. Weekly pay, you multiply by 52 weeks in a year. Biweekly, that's getting paid every 2 weeks, means you multiply by 26. And whatever you do, don't mix that up with semi-monthly, which is just 2 paychecks a month, so you multiply by 2. These numbers are your best friends for the exam. So once you've got that income number locked down, the very next step is to figure out, okay, what can this income actually support? This is where lenders use what are called qualifying ratios to figure out their risk and the borrower's affordability. You will absolutely need to know how to calculate these. The main ratio you're going to see tested over and over is the loan-to-value, or LTV. Think of this as the lender's perspective. It's all about their risk. It's a quick snapshot of how much of the property's value they're on the hook for. We're going to really focus on this one because it has a very specific rule you just have to know for the test. And here it is. Seriously, burn this into your brain. This is the golden rule of LTV. The exam just loves to give you both a purchase price and an appraised value. You must always base your calculation on whichever of those two numbers is lower. And why is that? Well, it's all about managing risk. It protects the lender from loaning out money on a property for more than it's actually worth. Let's see this golden rule in action. Okay, so the home is being bought for $350,000, but the appraiser comes back and says it's only worth $340,000. What do? We follow the rule. We completely ignore that higher purchase price. The entire calculation, from the loan amount to the final ratio, is based on that lower $340,000 value. And you can see, when we take the loan amount and divide it by that value, boom, we get an LTV of exactly 80%. So we know the loan to value. The next big question is, what's the actual monthly payment going to be? This brings us to the real heart of mortgage math. Now, you might see a big, scary-looking formula for this, but don't sweat it. It's really just made of 3 simple parts. The formula has 3 key ingredients. First up is P for principal, and that's just a fancy word for the loan amount itself. For the example we're about to walk through, let's just use a nice round number, $250,000. Next up is R for the rate. And here's where they might try to trick you on the exam. You have to use the monthly rate. So we take our 6% annual rate, we first turn it into a decimal, which is 0.06, and then we divide it by 12. That gives us 0.005. And finally, we have N, which is just the total number of payments over the life of the loan. For a standard 30-year mortgage, that's easy enough. 30 years times 12 months a year gives us a grand total of 360 payments. Okay, so with those 3 pieces, our P, our R, and our N, we can get our answer. The monthly principal and interest payment works out to be $1,498.75. That's our target. Now let's look at the formula that gets us there. And here's the whole shebang. It looks complicated, I know, but we've already defined every single piece of it. All we're doing is plugging in our $250,000 for P, our $0.005 for R, and our $360 for N. The rest is just being careful with your calculator. The key really is to break it down into smaller paces and not get intimidated. All right, we have calculated income, we've figured out ratios, and we've nailed the payment. But there's one final layer of math we need to talk about, and this one is all about compliance. Lenders have to run these tests to see if a loan's rates or fees are so high that they trigger special protections for the consumer. The first big question regulators are going to ask is this: is this loan a high-priced mortgage loan or HPML? To figure that out, we need to compare the loan's annual percentage rate, the APR, to a benchmark rate called the average prime offer rate, or APOR. This chart shows you exactly how it works. Let's say the benchmark rate, the APOR, is sitting at 6.5%. The rule for a first lien mortgage says that if the loan's APR is 1.5% or more above that APR, it's considered high-priced. So in our example, the loan's APR is 8.25%. The difference between the two is 1.75%, which is clearly over that 1.5% line. So what's the answer? Yes, this is an HPML. So this table kind of summarizes the key triggers you really need to have memorized. We just looked at the HPML test, which is that 1.5% over APOR, but there's an even stricter category for high-cost loans under a law called HOPA, and you'll notice the trigger for that is way higher. It's 6.5% over the APOR for the rate, or if the loan's points and fees are more than 5% of the total loan amount. Wow, we have covered a ton of ground, haven't we? From basic income math all the way to these complex compliance tests. So let's boil it all down into one final slide. Think of this as your personal cheat sheet for test day. Okay, here we go. Rapid fire tips. Rule 1. Income is always gross and always monthly. Got it? Rule 2. For LTV, the lower value between the appraisal and purchase price wins every single time. Rule 3. Know your income multipliers by heart. 52 for weekly, 26 for biweekly. Rule 4, that HPML trigger for a first lien loan is 1.5% over APOR. And here's a little bonus tip. Don't worry about the exam trying to trick you with weird partial months or specific dates on pay stubs. They're just testing these core ideas. So there you have it. You have all the building blocks, but the real key to mastering mortgage math isn't just watching me do it, it's doing it yourself. So take these formulas, take these rules, and start practicing. Which one are you going to tackle first to really build up that confidence for exam day?